I'm John Batchelor with Gordon Chang, my colleague and co-host, The Daily Beast. The general theme, you'll catch it from our conversation, is something's gone wrong with the Chinese miracle, badly wrong. It's not hard to see if you concentrate on military affairs, the snatching of the underwater drone, the boasting of anti-ship cruise missiles on the militarized islands of the South China Sea, the nuclear-capable bomber circling Taiwan, the protests, the enraged protests because the president-elect speaks to the president of Taiwan. That's all looking recognizable military confrontation. But the financial misbehavior in China is much more profound because this, if I understand it correctly, this present regime is built on the formula, we give you GDP, you give us silence. That's what's gone wrong. Gordon, we flapped with everybody else about the Chinese stock market about 6-9 months ago when it was gyrating madly. And the Chinese bought every day. The Chinese government bought every day and they stabilized it. It's a shell game. But now something's gone wrong in the bond market. What is the Chinese bond market? You tell me it's much more profound than the stock market.
Well, certainly, John, because it's and correct me if I'm wrong, but $9 trillion or so? But what happened last week, John, was that Janet Yellen on Wednesday increased U.S. interest rates and issued some hawkish forecasts for 2017. And then immediately on Thursday in China, the bond market collapses. And Anne is the best person in the world to describe what happened on Thursday and following days in China.
We welcome Anne Stevenson-Yang, our colleague, co-founder of J Capital Research in Beijing. Anne, a very good evening to you. What happened on Thursday?
Hi, John. Well, everyone started to sell off bonds in a panic because, bonds actually have a fairly illiquid market. There aren't a lot of institutions that trade them, but there are an awful lot of companies that use them for financing. And as Gordon said, this $9 trillion is no small amount. It's as big as all of China's GDP. So there started to be some panic selling. And they dropped about 1.5–2%, and then the regulators just halted trading. But then when trading was started again, there was another moment. I think it was yesterday when the bonds started to drop again. It's not over yet.
Yes, and the way that the authorities were able to rescue the situation on Thursday was to pump in $23 billion. And then on Friday, when Beijing has been boasting about the recovery in the Chinese bond market, there was a technical recovery, but that's because China dumped in $57 billion in short-term liquidity. And what happens? Monday, prices fall on the benchmark 10-year. This is a really serious situation in the sense that China keeps on putting money in and people keep on taking their money out, Anne.
Well, this is why it's not clear that they can hold on to the currency this year, because when you keep on trucking in money at that rate, then the money gets cheaper, and people want to take it over the border, and that's exactly what's happening. So originally Beijing targeted 6.8 renminbi to the dollar by this time. They've already gone close to 7 to the dollar, and pretty soon the dam is going to break.
Yeah, it's going to cross the 7-to-1 mark fairly soon. And essentially, Anne, if China allowed the currency to float, and if it took out all capital controls, China's money would be worthless. So essentially what we're looking at is, to a certain extent, market forces, but more the attitude of the Chinese government to support their currency. And many people in China right now at the highest levels of the central bank and in the financial planning circles in the Communist Party are thinking that they should just let the currency go because no country has ever successfully defended its currency against long-term market forces. And basically what's happening right now in China is you have everybody inside and outside China are betting against the renminbi.
Yeah, and it's kind of a losing game to keep defending it because everyone's expectation is that it will go nowhere but down, and so it's a chump's game. You're just spending your money for no particular reason. On the other hand, if you let it go, it's going to go to 10-to-1 before it stabilizes again, and that's going to be very, very dire for international markets and especially for the commodities world.
And is there a remedy to this for the government, for the masters in Beijing? Do they have a fix, or are they out of ideas?
The problem is that you really are, they're stuck between a rock and a hard place. So you can let the currency go and then have these bad consequences for international markets, or you could not let the currency go but allow defaults to occur domestically, and that's starting to happen. And neither of those choices is palatable to Beijing, but you simply don't have a third choice.
Yeah, there's no way out for these guys. And if you look at the State Administration of Foreign Exchange, which is the custodian of the Forex reserves, it says that after the end of November, China's foreign exchange reserves were $3.05 trillion. But if you start taking out illiquid investments from that number, and if you start taking away their phony forward contracts and the rest of it, these guys are probably somewhere like 2.7, maybe even 2.6 trillion. That's below the recommended guideline of the International Monetary Fund for the amount of reserves that China should have. At some point, people are going to understand that China doesn't have enough money in the till, and then there'll be panic.
Yes, I want to connect this. Just a moment, Ann. I want to connect this to us. There was a collapse in Asia in 1998. Led by the Russians, the Thais got involved. I can't remember all the circumstances, but there was a house of cards that fell down. Is that credible again on the basis of the way the Chinese bond market is behaving, Anne?
Well, I think that it's a very comparable situation because the 1998 collapse was similar to what happened in 2008 for the Chinese, and what they did was pour a lot of stimulus into their economy in order to counteract it and not have to take the consequences. As a result, you had a banking crisis and a recapitalization of the banks, which lasted a long time and took as much as 25% of GDP to accomplish. The problem is the issue now for the Chinese is of far, far greater magnitude than it was in 1998.
So we have a 98 risk. Is that where we are, or is it different?
No, I think it is very similar, but it's worse, I'm afraid.
And the Federal Reserve intervened in 98. The Treasury Secretary, Mr. Rubin, spoke calmingly. Alan Greenspan went to work, and we had a V-shaped in our own markets, and that would be credible, Gordon, to happen again?
Well, I mean, for China, the problem is that they're intervening as long as they have the capability to do so. And when they no longer have that capability, John, the market's going to go into free fall in China.
But it's not going to be isolated.
It's not going to be isolated, and it's going to be not a V. This is going to drop out, and then they're going to have a very long time for them to recover, because this is going to be Great Depression time for China.
And Stevenson-Yang and Stevenson-Yang is helping us. I wanted to ask about I can't. There's no time, Gordon, about the housing market, but I'm going to presume that it's similarly dire. J Capital Research in Beijing. I'm John Batchelor.